Hello and welcome to this very special Christmas conversations on money control. I'm Mahalakshmi and I have with me Sandeep Tandon from Quant Mutual Fund. Sandeep, thank you so much for your time today.
Yeah, thanks a lot for inviting us.
So, as we get into 2023, are you approaching this year with confidence or nervousness?
Okay, Mahalakshmi is an interesting question. Let me answer this as compared to what happened in December 2021 when we approached 2022 and we are in similar situation. Okay, as compared to December 2021 when we were approaching 2022, the globally we have seen the risk appetite has peaked out, liquidity has started declining. We saw euphoria in global equity, and if you dissect the euphoria, it is confined to the growth stock. Okay, now let's look at exactly 1 year later, where are we? Okay, if you ask me today, globally the tightening cycle has peaked out. Okay, and which means easing has started, and China is the first market where we are seeing good signs of easing as which has begun. And by the way, China has been one of the biggest liquidity provider in maybe in last 15 to 18 years. The biggest liquidity has come from China. Now if you look at the global risk appetite is also started rising, which is a good sign, which peaked out in February 2021 till September 2021, depending on which market or which country you look at. So with this background, the risk factor is far lower as compared to December 2021. So if when we entered in 2022, we have more signs to worry as compared to when we are entering 2023. At least geopolitical volatility data is slightly better. If I have to look at the high frequency economic parameter is also far superior than December 2021, which means market looks much better, or global market looks much better, and the narrative is still very negative. That's a very different issue. So data points are not that bad, but media noise is negative, narrative is very negative. And that's the reason we have seen with this background, Indian market has made all-time high, US market has rallied nearly 21-22%. So that's background. I think I'm more constructive. See this, if you recollect, we have been talking about a dynamic style of money management, and with that background, we have set based on our predictive analytics model that 2018 till 2023 calendar year I'm talking about will remain very volatile. We call it volatility expansion phase because volatility expand for 5 years and then get compressed. So with that background, we still expect that 2023 will be equally challenging, maybe more challenging than 2022 in terms of volatility. So which means the employed walls of the global asset class will remain elevated. Now, a lot of people actually get worried about volatility. People say, let market settle down, then I will come and participate. I don't mind hesitating buying 20% higher also, let market settle down. But I think what people have to understand that this invisible animal, which we call it volatility, if you can make your best friend, then you can manage your money. It is a psychological game. So I have seen a lot of people get capitulated at the bottom of the cycle, which happened very recently, and people get sucked in at the peak of the cycle. So that's the way we have to avoid. If you understand the phase, so we work on a concept of adaptive asset allocation. We try to understand what type of macro environment it is prevailing. If environment is suggesting that is going to be volatile, then I will make my portfolio rebalance or redesign accordingly. And this is the period which I talked about, the 2018 till 2023.
Yeah,
Globally, the buy and hold strategy will not work, and it has not worked.
right. True. So you talked about this difference in what the economic data is showing versus what is the narrative. So, in your view, what is causing this dissonance, and how does that get bridged, and when, more importantly?
So I tell you the challenge which most of the participants see, when people talk about, because see, numbers is one aspect, but everybody doesn't, don't subscribe. A lot of these datas are relatively more expensive globally. Okay, and B, people are used to seeing the media channels or watching newspaper or seeing the research report, which we believe comes with a lag effect. Okay, so you actually land up in doing a postmortem analysis, and then you get into say, yeah, that was the risk on phase, or this was the risk of phase. So we bring the concept of predictive analytics. Okay, it's a interesting concept where we try to connect the dot and try to see picture how it emerges. So this, based on that data analytics, we think the high frequency economic data are endorsing that economic indicators are actually improving. Recession cycle has peaked out. If you ask me, the interest rate from a medium term perspective has also peaked out, if I can say with confidence, about 10-year yield also. But big ugly picture of high interest rates, big ugly picture of inflation globally spending? Answer is big yes. We have been showcasing that 2020 till 2030 will be the very challenging phase. But it's not going to be linear move. We have seen one big crisis that has settled down. So we are in, if you ask me, inflation and interest rate, we are a structural bull run in US or developed market, but we are in cyclical down phase. Okay.
Mhm.
So if we can get that perspective with more clarity, then you can play and capitalize this opportunity in your favor rather than just worry too much about it that this will happen. And see, today, if you look at 2019, we have been talking about the 2021, 2020 onwards, commodity price will rally. 2021
Yeah.
inflation will come with a bang. And when we talked about, nobody was talking about. Now, whole world's talking about recession. The tenure and the quantum, people, somebody is looking at very mild, somebody is looking at very aggressive sort of recession coming. I don't think when whole world thing is recession is coming certain with certainty, that's a time it will not happen. So from a purely from a behavior perspective, that what we say narrative is more negative than the actual data.
How do you say that? Because if you just rewind and go back to last year, the expectation was that there will be rate hike, there will be aggressive rate hike going into this year, and that did play out. So even now, maybe we have not seen the effect of the rate hiking cycle, which is what the Fed also seems to be alluding to. So next year, economic effects of the rate hike cycle is to be yet felt next year. So on what basis are you saying that the economic data is looking good? Can we really trust the economic growth part so far and extrapolate it? Because that sends a very different signal compared to if you were to assume that the rate hike cycle impact will at least take about 6 months to play out in the real economy.
So, see again, whatever view which we form, since we look at much more macro data closely. So this entire thesis is not my personal biases we bring; it is the data-driven approach which we bring on the table. So it sometimes is very difficult to pinpoint each and every data because we subscribe a lot of things, and as I explained, we run a complex multivariance model where dependency on independent variables are more than the dependent variables. So it's mathematically we try to reduce the noise or the dependency on the price in terms of when we take a larger call on a sector stock or any economy or itself. So the way we look at is that yes, I agree the global ugly picture. I am to saying that what you have seen a 6 months back was a small trailer. The big ugly picture of high interest rate and high inflation is still pending. That's the way I use the word. We are
Right,
in structured bull run. Okay.
right.
But in structured bull run also, you will see cyclical downtrend phase. You will not say one way linear move. See, ultimately,
Right.
let's understand whom we are dealing in financial market. Okay. Whether it's India, whether it's US, we are dealing with the group of people, or we are dealing with human beings which has his own greed and fear aspect, and that is something which we try to specialize and quantify mathematically, the fear and greed. Okay, when extreme fear, let's give you a small example. Okay, let's talk about US market. Okay, in the month of September, October, if I'm not wrong, second week of October, the Quant capitulation index, or the fear, if I have to quantify in some manner, the fear index was closer to the COVID crisis. It was that number mathematically was as high as March 2020. Now, if you
Mhm.
look at that, was not the case in the environment point of view. We were nowhere close to what happened
Yeah,
to the March 2020. Okay,
right.
what is the prevailing environment was. But data came, and we talked about one of the channels, and some of in our conferences we have been talking about that even US market will give you maybe 15 to 20% return. We saw 21% return. So this is
Mhm.
what the strength of data analytics is, that whatever might be the narrative, but the outlook is yes very bleak from a global headwind perspective, but from a near term and medium term perspective, we are in cyclical. We believe that 4.35 or 36, whatever number we have seen in the 10 year, it has peaked out, it's corrected now. Okay, so and again you have to look at the global background which is coming, recession cycle, which people are worried about right now. I think some ingredients are there from a longer term perspective, but if I have to look at opportunity, because in market also everything is not long term, you have to capitalize the medium and near term
Yeah,
perspective. That's the way you generate alpha. If I say everything is long term, and this is the one big myth
correct,
we
correct.
generally I talk very blatantly about in the market when people say, oh, we buy stocks from longer term perspective. Okay, no, equity in asset class is a long term. Sector in stocks are not long term. So this is not a
Correct, correct.
thesis where people say I'm a long term holder. Okay, because see, you look at the Mahalakshmi will give you small example. We live in a dynamic world, and we see data points keeps on changing. Okay, do we change our portfolio? Answer is big no. Let's talk about COVID happening 2020, March 2020. Fundamental nothing got changed, and even the fundamental could have changed. It could, the real impact of earnings or any number change could be felt after few quarters or few years, and which exactly happened you realize much later on. But what
Yeah,
got changed in March 2020 was that risk appetite globally collapsed. It was 40-50 years low. The
yeah,
liquidity, because of central bank working together, was at lifetime high. So
yeah,
actually, it was a very lethal combination for a bull run, but nobody
yeah,
participated in that time because,
yeah,
and I'm thinking the postmortem analysis was very easy by September, and we took that advantage. We capitalized that opportunity. We deployed the money. One of the reasons we got massive outperformance was that we optimized the corona period or that crisis which was there by buying, not only going long in the market, but we also participated by May and June in a mid and small cap also in a big way. Okay, now if you look at by September 2020, market has rallied. Everybody talked about, oh, it's a liquidity driven rally, oh, tsunami of liquidity. Okay, now I'm saying, if as an analyst or as a money manager, you can't give this excuse, so nothing has changed, but it's a liquidity driven rally which we are not aware of. Okay, now let's say, I'll give you a very candid answer. Let's come to September 2021. We have few houses who are very vocal on the media also said it's a decade top for the technology stock in terms of
right,
valuation. But let's
right.
understand what happened. They were extremely euphoria globally, and if you dissect the euphoria into value or growth or any other sector, we realize that euphoria was confined to growth stock, most admired category stock, or the new age companies or technology stocks globally. They all peaked out. Global liquidity has started shrinking by the time. Risk appetite has also declining. So this is a very classic euphoria where we have said that easy phase of bull run is over, and global market with a lag effect of 6-8 months, by the May June, people realize, oh, technology, that was the peak of that cycle. Okay, and this is where we come into picture and say the importance of timing. If you can quantify these data points on the extreme instead of chasing momentum, which a lot of people do, instead of identify the market from an inflection points, if you see extreme inflection in the market, I think that is the opportunity to participate. Whether it's an opportunity to prune down your exposure, or opportunity to go aggressively long. So that changes. Let's look at February 2021. After that event got over, last 6-8 months we have been talking about tightening happening. Central banks are tightening, sentiments have turned bad.
Yeah,
But have we made any changes in our portfolio? Answer is no, because we are long term guy. Why should we make any changes? Because everything is long term. That is not
fair
the way
enough.
we look at. Okay. And
Yeah,
when I get these answer, and I get slightly irritated, ki, boss, you are missing out a
yes,
huge opportunity to generate alpha, and you are taking more risk in your portfolio. When environment is changed, you have to adopt these environments. Today, let's say I'm talking about, we are seeing clearly saying that the liquidity which was squeezed out or peaked out is coming back. The easy cycle has started. Now nobody on the ground is willing to believe that liquidity tightening is over. We are very data driven guy. We are very clear
so yeah,
saying
that's
easing.
what I wanted to ask you. So what is your predictive analysis really telling you now? First of all, you talked about the fear gauge, right? So where is that now? Does it indicate fear or greed, or where is it?
So we are looking at the way we look at data. A, risk appetite has started increasing globally. Okay, liquidity conditions have also started improving. As I said, that tightening phase, if I have to say, the tightening phase has peaked out. Okay, it has not started easing out that easily, but it has. What is very important, that cycle has peaked out, and when cycle peaks out, if you are early to capitalize. So with that background, when liquidity
But
expands
again,
and
how can
risk
you say
appetite.
that? Because by going sheerly by the statements by the Fed chair and the data that you're seeing, at least the market believes that another 50 basis point hike is in store, and still you
No,
have to wait to see.
okay, Mahalakshmi, don't link with the Fed interest rates and the 10-year interest rates or 10 years
Hmm.
yields. Okay,
Hmm.
they are
Hmm.
very
You're saying the
different
market is peak. Okay.
phenomena. Yeah, I am not saying that interest rate, even 50 bips hike, is not ruled out, but we are in fag end of that. Okay, with the
Hmm.
terminal is 5, our view is that maybe 5.31, 5.35, that should be the terminal numbers where it should peak out. So which is a quarter away maybe. But if you look at market is always ahead, market is at least 2 to 3
Okay.
quarters away. Okay, tightening started happening from February 2022, market peaked out in September 2021. Okay, the market was way ahead of this curve. Even similarly, I believe market is ahead. So 10-year yield has already peaked out. Okay, that 4.36 or 33, what was the number? I don't remember exactly. That's the number. I think it came to
Yeah.
that. So it has peaked out at that level, and now it is drifting down despite Fed has increased. Then why 10-year yields have not spiking? The Fed rates are still moving up. Ideally, then
Hmm.
the 10-year yield should also spike, which is not the case. So market is
Hmm.
looking very differently. This is a point which I am trying to
Okay.
convey. Sorry, I have a bad throat today. So, and this is a point which I'm trying to convey, that something has changed, and if you are early in spotting that change, you will take advantage of that. So if this background, then the whole world thinks the p deterioration will gather momentum has already happened. My view is that from a medium term perspective, or in a cyclical up move perspective, I think the time has come where globally p will slightly expand as compared to what is happening in last 1 year. Now I'm not talking about everything is relative in life, nothing is
Yeah.
absolute. So on a relative basis, on 1 year relative basis, I think p multiple globally will improve, which means we should be more constructive on global equities than what I was in September or December 2021. So clearly, as we enter 2023, the environment is slightly more conducive. And the good point is that I said that media noise is very negative. Best of the strategies are very negative. So it has all ingredients which is required for a recovery sort of thing. And the best part which I talked about, the China is recovering. Okay, and it
Sure.
is
So if you were
COVID.
to put your finger on where is your fear gauge today compared to any time in the past, let's say over the last 2 years, you said, in September it was as bad as it was in, March 2020. So where are we today compared to the last two
So,
years?
so if I have to look at India, let's say since we trade in Indian market more closely, and I'll come to US also. India day before yesterday, you see what happened on Friday last week. The market corrected significantly. The fear index, okay, one of the channel I talked about that India fear index has also spiked, but it has not spiked up to that extent what was there in COVID 2022, but it was
Hmm.
significantly high. But what
Hmm.
is very important, if you dissect the quant fear index into indices as well as the overall stocks, in if I have to segregate the indices and the stocks separately, then it's a very interesting data. Okay, so the fear index for all the stocks put together was marginally or was very close to the COVID level. Okay,
Hmm.
and that's the reason I said one of the channel I talked about the stocks have bottomed out. The certain stocks have bottomed out. Index may or may not. Okay, so this is the way we look at. So that was the opportunity to participate, though all possible technical levels have broken down. The confidence level has collapsed significantly, and which market look at very closely. So this is one of the, I said that market has actually become very light. Even the leverage position was on the lower side, and with this round of capitulation happening, I think it is preparing background for a good rally. And let's look at the market today. Metal stocks are up, which is a clear indication which I'm talking about. The China will be a driving force. China related sentiments or China linked sector or stocks will do better in 2023, which means commodities will do better than to the both precious and non-precious. Okay, and India per se is a very unique situation. So it might underperform in 2023. India might underperform China, maybe Indonesia. That is a possibility. I'm not ruling out. But what is very important for us to understand that in an absolute basis, on relative basis, India from a medium to longer term perspective, if somebody talk about 3 to 5 years, it's in a very sweet spot. So we like to
So you're
remain.
saying this year in 2023, we could underperform the rest of the world. Is that what you're saying?
I'm saying, I'm not saying rest of the world. We definitely can underperform China. Okay.
Okay,
Okay. We
okay.
can underperform Indonesia. We can underperform even US for a quarter or two. But because India has been, see, everything in life is relative. Okay. So we have seen extraordinary outperformance in the market. So it's possibility, and given the background that Chinese stocks particularly, they are in the most neglected territory. Okay, the risk appetite has virtually collapses after multi-decades low. It's inching up. Liquidity has also collapsed, which I've said that they have started easing. So China will be the first country should give you from I'm looking from a pure from a trading perspective, I think China will give you more returns. But if I look at it from investment point of view, which I look at more from a risk profiling point of view, India risk is far lower. So for my investment point of thesis, I think it remain constructive and long on India from both from short term and medium to long term perspective. China maybe for a year's perspective or few quarter perspective.
Okay. So when you say risk is lower, I mean, what are you considering? What kind of earnings growth are you looking at? Do you see this, compared to last 20-year average, our valuations are significantly higher than earlier, despite the fact that we are assuming that our growth rates are going to be a step higher than what we've seen in the last decade. So how do you see the earnings growth part from 1 to 3 year perspective and valuations?
The way we look at, I have been talking about, let's say from 2021 till 2030, globally this phase belongs to a value as a thesis, because in 2021, September 2021, growth has peaked out globally. It's not about just India. When I say growth stock has peaked out, they have peaked out not in terms of prices or earnings, they have peaked out from their valuation multiple. Okay. So if their valuation multiple has peaked out, which means these sectors, so the most admired category stock has potential to underperform the market or maybe as best market performer. So our thesis is how to identify the outperformer. The
Yeah.
outperformer will come from the background in the value, neglected, beaten down. And that's the area which I am talking about, that 2023 we expect a P expansion will happen given the liquidity and risk appetite expanding or increasing. With that background, which are the value stocks which you see earning potential also improving? Those are the stocks we took about. If you look at just pure index earning and the top down approach for Nifty 500 or Nifty 50, I think that will be misleading. You will not get the right answer. Okay,
Okay.
so we have to look at. So we work on a concept of money flow analysis, and where we're trying to see which are the sectors or earning or multiple has peaked out, and try to identify where money will shift. How money shift from high risk to low risk environment. Similarly, purely on the money flow analysis, when we look at the sector allocations or sector calls or the stocks calls, I think that is the better play. To 2023 will be more on a value thesis, more on the beaten down names, and more on the uh, select stocks rather than the index in general.
Sure. And where are those pockets? You're talking about beaten down stocks. I'm scratching my head to think about beaten down stocks.
So there are many such stocks. I think if I have to look at larger thesis, we are talking about manufacturing is a thesis, which I'm saying is could be a decade opportunity for manufacturing. Maybe could be half century opportunity for India. That's
No,
what
but from this year's perspective, I'm talking only from
yeah. So
2023
I'm saying
perspective.
when obviously when you look at a decade perspective also, these are the early years, baby steps people will take to fulfill that dream. So we're talking about related to banking. So when you talk about banking, not necessary private sector, they are relatively some of the private sector banks also corrected in last 2 years. From 2018 they have corrected significantly, not necessary in prices but in terms of valuation multiple they have corrected a lot. So maybe PSU banks looks better than the private sector banks. So anything revolves around value as a thesis. We have to look at a material as a thing, whether it's an engineering stock. I agree, engineering is the one area, or capital goods stocks are not that cheap, but you
Yeah.
will find some opportunity in the industrial space. We like space, like I was talking about, that one can look at now, even for the material stocks, metal in particular, given the background where we are talking about China opening up, and China macro data is also going to improve. So at least demands point of view, the less challenges, more from the metals is driven by the sentiments from China. And if that also improves, I think this is one area which has corrected a lot in last 1 year. So there are such opportunities which you will get, okay, in the neglected and beaten down space.
Anything
Okay,
else? You're talking about metals and materials. You're talking about banks. Anything else?
we're talking about industrials, infra names. Okay, mm, so you have to identify opportunity. If you're talking about like a lot of people are playing, instead of playing through real estate, you are playing through building materials. So there are opportunities. Not like everything is very expensive. So you have to identify under ownership. You have to identify relatively cheap. I'm using the word relative because in capital good everything is expensive, but not is the case. Like metals, nothing is very expensive. Everything right from the large cap to mid cap to small caps, they are very attractive. PSU banks are still very attractive.
But again,
Oil
global
marketing
metals,
companies.
your assumption is that, next year will be buoyant. I mean, unless you make the assumption that the world is not going into a recession and China is not going to remain subdued, you
So
cannot
we
make a
don't
very
work.
strong case for.
So Mahalakshmi, we don't work on assumptions in any manner. Okay, we always say we are slave of data. If data change, we will rebalance our portfolio. We are not married with any thesis or any view. We have taken a view, a 10 years view or 5 years view on particular sector, and we will not change. Okay, as I said, last 1 year we were cautious and negative. Okay, on the global equities, particularly in terms of valuation multiple. I think now time has come where valuation multiple can has potential to expand from the current level. With that background which I'm talking about, you see opportunity because we are seeing actual economic data which is actually improving for the Chinese equities and China as a sentiment. So this is the area, and if whatever reason, let's say government play around with the export duty which has been imposed, if that get removed, which is could be the case, then also they get further rated. But I'm not banking on that. The whole thesis is that
Hmm.
something will change in data from a macro perspective, and is changing in China in a big way, irrespective of whatever negative noise might be. So as long data is supporting us, we will be participating, and when data change, we have no hesitation in book profit or move out.
Sure. In the consumer space, what is data telling you? Because there seems to be a lot of dissonance in data on, if you look at the corporate figures, the volume figures, you see that there is a lot of, stress in the system, especially rural demand, etc. Is there anything else that you're picking up?
So the early signs are whatever sense we are getting from the ground that even rural demand is picking up. Okay, we have seen urban demand post COVID thing, it has spiked. There was a vengeance to go out. We have seen that move, and with the good crops which is doing, the demand, agriculture prices have moved. So farmers have been a beneficiary of that. I think we are getting a very early signs of agri demands or the rural demands picking up. So we are also constructive on the rural space. See, the problem in the staple space or the FMCG space or the consumption names, or some of the names are very, very expensive. Okay. And I
Yeah.
said it doesn't fit into our thesis because when we are talking about that from a longer term perspective, these are the sectors or the earning multiple has peaked out, but there are opportunity. Okay. There are many such opportunity. If you see our portfolio, you will find some of these names which we own because we see opportunity. Definitely, we are very constructive on consumption. When we're talking about India is a very unique play, then obviously India is all about population and India is all about consumption play. Okay, so you cannot, and it's not the consumption is just confined to the FMCG or staple names. Consumption can be linked with your material space also, can be looked for the housing space because we are very bullish on the housing space. So the housing finance company or materials company. So consumption is a much larger concept, but provided you are able to identify stocks and sector which has relatively under-owned stocks, relative underperformance is there. So if they are there, and there are many such names who are trading and neglected and beaten down names. Those are the names. I think that 2023 is all about neglected and beaten down names.
Sure. And anything that you find are complete avoidables? You, of course, talked about, highly expensive consumer names. Anything else that you find avoidable?
No, I don't think. I think as a thesis, I explain you only we are not very keen on anything which is expensive, anything which is traded in the most admired category. Let me, irrespective of whichever the stock the sector might be, anything which is in the most admired category,
Hmm.
grossly overowned, okay, grossly over research, okay, and being a consensus names. Those are the stocks which will not give you alpha in 2023, and
Today,
those are
if you
low
see,
over
even
risk.
banking comes as consensus buy. There is no contrarianism in banking. So, in that sense,
No, banking,
most most
banking, yes, can be consensus from yes, everybody. But if you look at the ownership, where is the ownership in PSU banks? Okay, where is the ownership in many private sector names also, which has corrected a lot. Okay, I'm not getting to name specific. Okay, barring few top three names or top two names or top four names, there the sector is grossly underowned because it's underperformed from 2018 January 2018 till September 2021. Banking has underperformed significantly, and conviction level is on the, see, people talk about, see, I look at the
yeah.
data, whether the it is reflecting. Okay, like look at PSU bank has rallied, it corrected also. Okay, but where is the ownership? Look at the holdings of the FIs and mutual fund, where hardly anybody owns these names in the, like, maybe except State Bank and maybe BOP or Canara could be exception. These are the three names. You look at the list is very big, And so is the case in some other names also. So I'm saying if you look at the top 2 3 private sector names, within private sector also they are under ownership in a big way.
Sure. So within the banking space, you would say, the SBI, ICICIs of the world could actually be on the back foot next year. I mean, there will be churn in terms of how the whole pack performs.
So I'm saying if India activity, economic activities is picking up, okay, capex cycle has come, banks are naturally beneficiary of leverage economy. So there should be the biggest beneficiary. The only thing which I'm trying to highlight is that maybe from time to time you also have to rotate your sector or stocks, okay, within that larger basket, depending on the over ownership, depending on the overvaluation or the consensus get built. But within that you will get opportunity, and it's up to us how well we can capitalize that.
Sure. So finally, Sandeep, where do you think Nifty will be by the end of next year? Same time next year?
So I am not really any expert to quantify where the Nifty would be, but as a equity thing, we think as a equity, as an asset class, I think will still generate good alpha, provided you follow certain risk mechanism in place. I talked about doing sector rotation right time, stock selection right time. I think those are the thesis. If you play out, I'm in the camp that equity as asset class will generate far superior return in 2023 as compared to consensus call of debt market. Okay, despite interest rates are rising, given the high inflation, I think equity is the best product to capitalize, provided you play it right. Don't get carried away too much when there's a hype. Don't get too much panic when there's a crisis. Those are the moments you have to sell or you have to buy. If you can follow some of the discipline, don't get carried away with these developments. I think decent alpha will be generated in 2023 also.
Sure, sure. On that note, thank you so much for today's discussion, Sandeep. Wish you a very happy new year.
Yeah, same to you and your team also. Thanks a lot. Bye bye.
Thanks.